Financial advisors are everywhere. Every bank and every fund company, they're after your money, it seems. Countless news outlets have even been caught being paid to market companies in articles. The reader's unaware, of course. You really can't trust anyone. That's why it's important to remember to listen carefully in your portfolio building class in high school. Oh, that's right. Financial education wasn't taught in school. That's okay. It's time we all learn more than just invest for the long term in a balanced portfolio. You came here for the truth, so let me unveil that for you. Today we are going to look at how to build a portfolio the proper way. Disclaimer, this is not financial advice. Why invest? The purpose of investing is to safely protect your wealth as well as to have your assets increase faster than inflation. We must first understand why we're doing this. If you don't know, then you shouldn't be doing it. We know that currencies are all losing value to real goods, so we must put our money in things that exceeds the current rate of inflation and yet are safe enough to leave our hard-earned money in for a long period of time. So we can look out there and see that there are many different types of investments, each have their own risk level, but when you add time into it, that also adds another dimension. Asset classes. In the Money GPS, I discussed the 4 asset classes and the importance of holding all of them. There's a very clear distinction in holding an actual physical asset, like a house or a gold coin, compared to a REIT, real estate investment trust, or a precious metals ETF. These are derivatives of those assets and should be considered as such. I often hear about individuals in the financial industry ensuring that people have a well-balanced portfolio, and yet it is all paper assets. That is not a well-balanced portfolio, but it is a well-balanced paper asset portfolio. And even in those cases, it's not actually well-balanced. If you want to protect your wealth, you need to be diversified. Most investors can't do this because they are unwilling to spend enough time to learn about protecting their wealth and making money. Each asset class has benefits that the others do not have, making each one unique. Passive versus active. Today we have seen maximum growth in passive investing with people purchasing large amounts of ETFs and dropping out of actively managed funds that were so dominant prior to the financial crisis. The trouble with ETFs is that unlike a portfolio, you give up complete control. You are essentially suggesting that you don't know which stocks will do well, but you know that the market will go higher. And that's basically allowing them to take control of it and you step aside. It's basically a mutual fund. The only difference is that you can trade it like a stock. Throughout this bull market, ETFs based on the market have performed well in many cases. If investors begin selling them, however, it will be very difficult as you will have large amounts of people leaving through the same door. If you were involved in the financial sector during the last financial crisis, ETFs were such a small portion. Today, they consume a much larger portion, so we're going to see what happens when these passive type investments see large outflows. Bonds. Perhaps the most legendary investor of all time, Benjamin Graham, the author of the classic The Intelligent Investor, would have been ridiculed today. If you don't know who Benjamin Graham is, he's the one who taught Warren Buffett. Essentially, he believed there's much more risk in equities and that portfolios should include more bonds which are, quote, guaranteed through the ups and downs. The book was written many years ago, and while some things have changed, ultimately we have the same foundational principles. The importance of receiving a percentage of return from an investment is so often overlooked by investors in hopes of catching the next Amazon or one of these unicorn companies. If you haven't read The Intelligent Investor, despite the fact that it was written such a long time ago, it is absolutely one of those books that everybody should have on their shelf. Appreciation versus passive income. We must understand why exactly you are investing. To make a certain amount of money? To bring in a particular amount of income monthly? To protect your wealth? To beat inflation since the bank pays essentially nothing? These are all questions that you should ask before ever spending a dime on any type of asset. What are your goals? Why are you investing? Achieving the maximum amount of appreciation is not a strategy for most people because that comes at a price throughout cycles. For some people, leaving money in a savings account is just fine for them, and there's nothing wrong with that. Every person has their own different goals and their desires. For some people, that's going to look like the complete opposite, a 180 from what other people have. And each one is not necessarily better or worse. You just need to do what's right for you and your situation and your goals. Getting passive income means that you invest in an asset that will consistently provide income regardless of the fluctuations in the market. So think about, for example, dividends in a stock. The stock can go up, it can go down, but regardless, you are getting a quarterly paycheck. Diversification. A truly diversified portfolio includes all asset classes. These are accumulated and held throughout cycles when they are undervalued. That's the way that you are supposed to get an asset. You don't buy it when it's at its peak, and you don't buy the exact same type of asset decade after decade after decade. You are supposed to accumulate certain assets when they are undervalued, and you can hold that particular asset class. You don't purchase any more, or maybe just in certain cases, but you would then hold. And then when things look undervalued, you can then decide you want to buy more or what have you. But if you've been investing in passive income type investments, no matter what those assets are doing at that time, you are still bringing in income. For the purposes of this video though, we will only cover the paper assets portion. That's where most people put their money, and I don't even think people are doing this part right. So we'll focus on that, and I have other videos in my free e-course that get into the other asset classes as well. Building a portfolio. A well-balanced portfolio must be designed with current conditions in mind. Is the economy in a stage of expansion or contraction? A portfolio should be rebalanced to some degree over time. That doesn't mean that you go ahead and sell everything you have just because there's a contraction or just because there's a recession, but you may rebalance your portfolio. So you may sell off particular assets that you feel are risky right now, and you move your money into something maybe that gives a really nice dividend, or maybe a company that's been around for 50 years and they're a steady and stable one over time. So you're basically changing the weightings of these different stocks or bonds depending on the situation. Questions to ask are, what are my goals? What is my risk tolerance? Will I invest as a monthly recurring event or just a single initial investment? All of these factors will depend on your personal situation. Breaking down a portfolio. There are many sections in a portfolio, and of course this depends on your goals. Each can be broken down further and further, shifted around based on conditions as they change. Many people, they just consistently accumulate without any thought, and of course that is extremely dangerous. These are not actual people in the financial industry, even they have more sense than that, but this really needs to be understood. You may be an aggressive investor, and so you have more equities than bonds, less passive ETFs, and more growth stocks in general. Or you may be on the opposite end of the spectrum and be entirely passive, holding just a few ETFs of the general market, regularly buying more shares in a dollar cost average method. Again, each person is different. Each sector has unique benefits. Each of the sections of a portfolio are included not just for diversification purposes, but exposure to those particular industries. Before you buy a particular stock, you should understand the sector. You may invest in technology because you feel new research has shown AI-related businesses are growing rapidly and have long-term potential, for example. So now you know that that particular sector, that particular industry is interesting. So then you go into the particular stocks. You don't do it the other way around. You may invest in resources because you feel energy needs are increasing throughout the world. If that was the case, then you start looking at which stocks are positioned the best. Zoom out before you start looking at stock picks, which are often paid promotions. You're going to go through this mental strategy and be able to decide what looks good. True diversification. True diversification is within an asset class, but it's also within a sector. So you're going to have multiple asset classes. Then within that particular asset class, you're going to have diversification, multiple stocks, multiple different types of bonds. But you're also going to have diversification within a sector itself. So you're not just going to hold, for example, one tech stock. You're going to hold multiple tech stocks. For example, if you own a technology stock such as Facebook, you may also include a competitor like Twitter, potential companies for acquisition, and a few other similar technology companies. The purpose is to reduce exposure to one particular corporation. Every single company, no matter how big or how prevalent, is not impervious to a breakdown. Spreading out among other similar companies will most likely have a similar pattern, but it reduces risk. So if you look at the charts and you see particular industries, for example, tech stocks or resources or utilities, they generally move in the same direction. Some companies will perform better than others, there's no doubt about that, but in general, you see them moving together. But on some occasions, you see one company being hit very hard. If you spread out that risk, you're going to mitigate any potential losses that you may encounter. Bonds should play a role in any paper asset portfolio because it gives an investor a chance to get a return on their money at a set rate. If you buy a stock today, you can make an assumption that it will be worth more tomorrow, but this is not certain. With a bond, you are essentially agreeing upon terms. I give you money today, and in 10 years, you give it back to me plus interest. This, of course, makes the assumption that the corporation or government hasn't defaulted on their debt. Government versus corporate bonds. Every bond has a different level of risk associated with it. There is also time as a factor. Perhaps you feel that Italy will be able to pay you back in 1 year, but you're not sure if they will after 10 years. Generally, you get a higher rate of return with longer dated bonds, but with it, you also get higher risk. Corporate bonds are interesting because some companies may even outlast governments. There are some companies that have been in operation for decades and have consistently paid good money to investors. Remember to consider any possible future regulations or developments that could cripple a particular industry. You may think it's wise to get in with a coal company today, but 10 years from now, maybe that's not the case. Passive income. Having stocks that provide dividends is great because you know that every quarter you will get a nice paycheck. Each company may give a different amount, but the fact that you're getting money while the stock hopefully appreciates is really the best part. Imagine the story of the golden goose. If you sell your shares, you are essentially getting rid of the goose. If you keep the shares, you can collect the dividends forever. That's the way I see a lot of these different types of investments. When you chase appreciation, you're going to get rid of the goose. You don't want to do that. You want the eggs. Yes, the eggs are smaller than the goose, but if you keep them for a long period of time, they're going to add up and they'll be bigger than that goose, as well as the fact that as long as you maintain that, you're going to continuously get those eggs. Always be mindful of how long this company has been giving dividends for and see if there were any changes during previous recessions. Always do your due diligence before investing. Penny stocks. If you're going to invest into penny stocks or small caps, you need to understand the risk factor. These companies are significantly more volatile. Funds that have large portfolios often include these, but as a small percentage of the total. There are ETFs that will give broad exposure to small caps to spread out the risk. So if you're not sure exactly which company to invest in, but you wanted some exposure to it, then individuals tend to go for the ETFs to do so. Leverage. Many people today use margin or invest with leverage. This is not a wise decision as people learn regularly, not even during a recession, that a swing in the wrong direction results in a margin call. It's best to invest only what you have. If you lose it, you can deal with it. Otherwise, you can truly regret what you've just done. Multi-layered portfolio. These are not recommendations for portfolios, just a hypothetical example. This is just basically the stock portion that I wanted to give you some insight. I couldn't really draw this up properly of how I wanted it to look, but we'll talk about this. So for example, you got multiple sectors on the left-hand side: technology, resources, and financial. In the technology, you would have something like 50% Apple, 30% Amazon, 10% Netflix, 5% Intel, and then maybe a 5% of the FANG ETF. So you're going to get broad exposure through the ETF. Then you're going to choose your individual stocks. And of course, you would want many more stocks than this. I just didn't want to type out 100 different stocks. You can see that you want multiple names that are similar and also others in the same sector. Like I said previously, you invest in Facebook, maybe you're going to also invest in Twitter. And this gives you exposure to both these social media corporations, and that's how you can diversify even within that particular sector. So maybe you really favor Apple, but you're also going to include others within that technology sector because of the potential failure. Not to mention the fact that other stocks may perform much better. Resources, 90% Exxon, 10% oil ETF. So if you are in that resources field, you can get into the stocks, but you can also get into the ETFs that are based on the commodity. So that is a different type of diversification. In the financials, you can see 50% JP Morgan, 40% Goldman Sachs, 10% financial sector ETF. This is a way to spread out the risk, and you're also getting exposure to others that you didn't before if you're just buying into an ETF or if you're just buying stocks. The percentages here are depending on your risk, depending on your goals, and so on, as we talked about earlier. Part of this, which I didn't include, are the bonds. So you may buy these bonds at the different companies which you feel are safe, which give you a good rate of return, and potentially even government bonds. So many investors look to US government bonds as being the safest around the world, and oddly, they actually are giving better returns than a lot of the countries in Europe today. The point about bonds is that you are diversifying as well as getting that supposed guaranteed income. Yes, it might be lower than what you think your appreciation on that Apple stock will be, but at least you can make assumptions as to what your returns are going to be at the end of those terms. Again, just like anything else, nothing in life is certain. You don't know what's going to happen, if that government is going to go bankrupt, if that company is going to go bankrupt. You don't know if your stock is going to appreciate or depreciate. All of this is risk, and you need to just break that down for yourself, looking at it, really taking time to investigate and actually building a multi-layered portfolio, doing it the right way. If you found this presentation informative, please give me a thumbs up. When you give me a like on this video, you are supporting this channel, so I do appreciate that very much. If you want the financial education that you weren't taught in school, these two books have everything you need from top to bottom, from A to Z. Check them out at the link in the description. If you want the audiobook, that's available at themoneygps.com. If you want more educational videos, I have an entire e-course for free. Just click on this link. It's going to bring you to the playlist, and you can see all of the ones that you're interested in watching, and I will see you there.